we'll try to do this morning, right, is leave the normal world of P multiples and 50-day moving average and recent result mein kya hua. We'll leave all of that behind and we'll try to think more creatively on how to make lots of money in the stock market without taking crazy amounts of risk, right? And what we have done in Marcellus is spent a long time, best part of 20 years, thinking this through. And what we have come to the realization is the only way to do this, right, to make stupendous amounts of wealth, as I said in one of my books, without taking high amounts of risk, is to invest in companies who are going on to conquer their sectors and in some cases going on to conquer the world, right? It's not easy to do this, obviously, conquering your sector in India and conquering the world. But what we are seeing globally and increasingly so in India, right, what we are seeing increasingly so in India is even small companies, $500 million, $1 billion, $2 billion in market cap are building powerhouse monopolies, which have no competition. No competition, right? That's why I titled this session, Rising Giants. You would have heard us speak in the past about Nestle, Asian Paints, right? HDFC Bank, we love them. We have them in many of our portfolios. Several of you here are our clients. I'm going to discuss some of them, but I'll also discuss the next wave of Indian monopolists who are coming through. And in the last 4 years, it's become increasingly apparent that this trend is becoming very pronounced. Indian companies, we only focus on listed, so we get to see $500 million, $1 billion pay, but complete dominance, right? And the most fascinating aspect of this type of investing, and the reason these sessions are sort of useful both for us as investors and you as potentially other people who will invest in the stock market, is these companies don't go out of their way to publicize themselves, right? They will not come on TV or in the press. They will not quote brokers or fund managers. They will just sit there quietly in the office, building enormous wealth. And therefore, by building a network of people, I understand Edge is a network, right? I understand our client network is also another network. By building a network of people, people who are interested in investing, interested in finding great companies and investing in them for very long periods of time, by building these networks, we make it easier for ourselves, all of us, to find these companies, because you ain't going to open the newspaper tomorrow morning and see an interview with these CEOs. They're not interested. They will not quote public limelight. Okay? So that's the journey we're going to go on. How do we discover the rising giants, the next generation of multi-billionaire monopolists in India? Today they're at $500 million, $1 billion, $2 billion, but they're on the way to conquering the world. So I'll lay out the framework step by step. I'll start macro, and we'll go right down to the company level, and we'll do a few sectors, and hopefully in 35, 40 minutes time, we will be able to go into Q&A mode. So let's start with the sort of the most oft-asked question, right? What is the India growth story? What is happening in the India growth story? Our country's economy actually isn't that hard to understand, right? We're still a very poor country. And that makes India's macroeconomy actually quite straightforward to figure out. Because our macroeconomy is relatively straightforward to figure out, last year in March, where everybody was panicking, we were loading up big time on the next generation of Indian monopolists. We were telling the public, on TV channels, in our webinars, in our newsletters, that load up on India because we're going to see an economic boom in the next 2, 3, 4 years, right? Now, why were we so confident? Why did we stick our neck out, some would argue, in such an aggressive manner last March? The answer lies in this chart. The first version of this chart was published in middle of March last year. I remember the Sensex, the Nifty Sensex had gone gap down 12th or 13th March. We published it 7-8 days later, right? And this is when we said, load up on India big time, right? The simple point that I'll drive at in this chart is, our country's economy is so straightforward to understand that whenever America goes into recession in year T, in year T plus 1, our boom begins. By boom, I mean a period of rising economic growth, right? So let's go through that. Why does this happen and how can we benefit from it? The red chevrons in the chart are India's economic booms. We've had only 4. The dark gray areas that stand out, they are periods of recession in America. And you'll see, first you get the dark gray area and then you get the red chevron. So let's take it one by one. America went into recession 1979 because of the Gulf oil price, the oil price zipping up in the graphs. There was the hostage crisis in Iran and so on. 79 to 81, America was in recession. 1982, India's first economic boom after independence started. It lasted 5 years. I was in school in Delhi, and I remember several of my classmates stopped using the school bus. First, they would come to school in Maruti cars, which in those days was an unimaginable luxury. And then a few of them, us zamane ke unusual billionaires, started coming to school in imported cars, right? It was unbelievable, right? And all happened in 5 years. The first 5-year economic boom in India, 82 to 87. America went into recession, 1990, Gulf War hua 91, 90 to 92, America was in recession, 90 to 92. 93, a second economic boom began. It lasted till 97. The East Asian crisis, the Russian crisis put paid to that. As everybody knows, America went to recession 2000, dot-com bust, agle saal 9/11, then Ketan Parekh scam in India. 2000 to 2002, America was in recession. 2003, 2004, our third economic boom began. That lasted till Lehman Brothers, 2008, fat gaya. 2008, America went into recession. India's last economic boom began 2009, it ended in 2011, right? So this rule, US recession T, Indian boom T plus 1, is a 100% success rate, 4 out of 4, right? Now, the reverse is also fascinatingly true. It does not matter what policies we announce in our country. If America does not go into recession, you don't get a boom in India, right? Now, why? Why is this? Why does this link exist? Now let's move to the 2 lines. The 2 lines in the chart, those lines contain the answer. The orange line is the price of crude oil, right? America is the world's largest user of crude. When America goes into recession, the price of crude falls by 50 to 80%. A 50 to 80% drop in the price of crude is around a 3% of GDP stimulus, gift to us, because we import oil, right? So first off, when oil got smashed from $85 to $0, we immediately did the maths and said 4% GDP we're getting gift from the world, right? That's an immediate boost. You don't have to do any science for that. Now, I think the government's done the right thing. They've kept the price of petrol or diesel at the pump same, or actually they've raised it a bit, and they've loaded up taxes on it. They're taking that money and funding the fisc, which I think is fine. But the boost to us is unquestionable. Basically, we get a free gift of 3-4% of GDP when oil gets smashed. The blue line now, that's the 10-year bond yield, US 10-year bond yield, right? It's been falling for our entire careers. Most specifically though, wherever there's a gray area, wherever there's a US recession, the US 10-year bond yields falls even more sharply. Because when America goes into recession, the Federal Reserve cuts rates. Typically in a US recession, the US 10-year bond yield falls 2.5%. When in a US recession, the US bond yield falls, US interest rates fall, the RBI passes it on to you and me, because at that juncture, they don't have to worry about the current account deficit. Why? Because oil is already squashed. So an American recession, astonishingly, leads to 2.5% drop in cost of funding in our country. Right? So we wrote about this in March. It played out picture perfect in the last 8-9 months. Right? The RBI has cut cost of funding in our country is down 2.5%. The US 10-year bond yield went from 2.5 to 0. It's up to 1 now, but it fell exactly as per the textbook. Basically, in simple English, an American recession gives India sasta tel or sasta paisa, cheap oil and cheap money. And that's all our entrepreneurial nation needs to stoke an economic recovery. You give India cheap oil and cheap money, there is enormous entrepreneurial talent in this country, in this room. And we go off to the races and the economy zips up, right? And we see typically a 3-year economic boom. That started. You saw the IIP data yesterday. IIP for the December quarter yesterday. The economy, IIP is growing, right? You saw the December quarter results yesterday. You can see truck demand. You can see record levels of power demand. You can see mortgage offtake going to record levels. Marcellus is doing a call with Keki Mistry on Tuesday evening on what they are seeing in HDFC, because HDFC is reporting record volumes of mortgages, and that's a critical sector. If you get home building going in India, if you get mortgages going, you get home building going, that's your capex cycle almost done. Chalu ho gaya. Right? Uske upar the budget is a nice good to have, right? So we are off to the races. The economic recovery has begun. The IIP data for December validates that. But the question is, who will make money in this recovery? पैसा आप कैसे बनाओगे, हम कैसे बनाएंगे पैसा? Most of you will be tempted big time to buy real estate developers, road builders, construction companies, right, through this economic pickup. Why will you be tempted? Because earnings growth for construction companies, real estate developers, road builders, power and infrastructure companies, earnings growth will zip up. Next 3-4 quarters, tod-fod earnings growth aayega. And it'll be incredibly easy to get seduced, because aapko broker or fund manager will tell you, look sir, stock is sasta, earnings growth dekhiye, P multiple dekhiye, jump in and make money. But it's not going to work. That'll last for a year, maybe a year and a half. The companies that will make the most amount of money in this economic boom that has started, the companies that will make the most amount of money will be giant monopolists, leviathans as we call them, giant monopolists who dominate our economy, right? So what the data shows is very interesting. The data shows that 20 large companies now take home 70% of India's profits, right? We're doing this year's crunch. Hopefully we'll publish that at the end of Feb. But just to use the crunch that we did last year, let's start with the chart on the left, right? The chart on the left is showing you the profit share of the top 20 profit generators in India, right? Straightforward stuff. We go to the Ministry of Corporate Affairs. You get the profits of the top 20,000 companies. That's the denominator. Then you go to the stock market. You get the profits of the top 20 profit generators, right? And top 20 divided by total profit. Early 90s, when we liberalized the country, the top 20 profit generators in India accounted for a mere 15%, 15, of India's profits, right? Us zamane mein top 20 profit generators in the early 90s were Hindustan Motors, Premier Padmini, Mafatlal, Century Textiles, these sorts of people, right? Then if you move forward with that chart, right, by the time my colleagues and I migrated to India around 2008-9, by the time we migrated to India, top 20 profit generators were accounting for around 30%, 30% of the country's profits. By the year ending March 19, top 20 were accounting for 2/3 of India's profits. Year ending March 20, the number is around 70%. I reckon the current fiscal, the fiscal that will end in 6 weeks, I think top 20 will be 3/4 of India's profits. Right? 20 giant companies taking home 3/4 of profits. If you want to look at free cash flows, the dominance is even higher. Top 20 take home 80% plus of the country's free cash flow generation. Right? It's astonishing. There is no other large economy so dominated by giant companies. Now, the first level of understanding how to make money in India is to go deep inside this phenomenon, right? And I'll unpeel the onion layer by layer, but this is the most fascinating aspect of our economy, the dominance of each sector by one or two companies, right? So if you look at the table on the right, pretty much every sector in our country, whether product or service is essential for our day-to-day lives, either one company or at most two companies are taking home 80% of the profits, right? And many of these companies are familiar. You would have heard me speak about it several times, right? What we'll try to do is understand why this dominance has arisen and how you and I can profit from this. How can we make money from this? And that insight will also take us into how we can identify the next generation of giant monopolists, right? So let's start with the first layer of why investing in these monopolies makes us money. It'll also give you an insight into how these monopolies are constructed. The typical top 20, top 25 monopolist in India, his return on capital is around 45%. So return on capital employed, just to be clear, so that we all use the common definition, return on capital is nothing other than operating profit, or EBIT if you want to be technical, divided by denominator mein total debt and total equity of the company, total capital employed. Simple formula. EBIT denominator divided by total capital employed. The average for a top 20, 25 monopolist in India is 45%. No other country has anything like this. So a lot of people get very excited, FANG stocks and Walmart and Chevron and BP and Sony and Toyota. You can go and have a look at the annual reports. What you'll see is outside India, very, very difficult for world-class companies to even hit 20% ROC. Agar 20% ROC they hit, no books are written on them, they become celebrities. In our country, the monopolists we invest in, they don't step out of their house for 20% ROC. 30% is the minimum ask. Right? Any self-respecting business person in India, 30% is the minimum ask. 20% ke liye to, mera assistant jayega, type of thing, right? And on a side note, just commenting on the sort of social scene in our country, at 45%, as many of you have seen, as 45%, the monopolist daughter marries another monopolist son. Right? That's probably a different edge session, right? Not for me. I think Yash Raj will have to get a different speaker for that edge session, right? Beyond my pay grade. Anyway, coming back to this edge session, if you generate 45% ROC, that gives you a lever to make lots of money, because free cash flow for any company, right? Whether it's our host today or whether it is a giant company like Reliance Industries or whether chota sa Marcellus, free cash flow is nothing other than return on capital minus cost of capital, right? It's a very intuitive equation for some others thoda sa sense lagta hai. Offline, I'm happy to help you understand this. It's a very simple, very powerful equation. Free cash flow, ROC, free cash flow is equal to ROC minus cost of capital, right? If you ask me, this equation does more heavy lifting in finance than anything else, right? Assume return on capital is 45, cost of capital is 15. Delta, therefore, is 30%. 30% is the free cash flow. 30% of capital employed is what the Indian monopolist throws off every year. The business is throwing the cash off. What we have shown in our books is whether the monopolist is in Chennai or Chandigarh, it does not matter. All of these elite families think and work in a very similar manner. 1/3 of that free cash flow, they dividend out. So around 10% of capital employed, they dividend out. The monopolist owns 70-75% of the stock. So the dividend comes back to him and it finances the family's lifestyle. Right? Lifestyle is taken care of. They don't have to steal money. The dividend finances their lifestyle. 2/3 of free cash flow, 2/3 of 30%, they slam it back into the business. 2/3 of 30%, therefore, is 20%, right? If you keep reinvesting 20% of capital employed, you're opening new factories, you're launching new products. If you keep reinvesting 20% back into your business, any business, provided the promoter has some basic common sense, what will happen? Profits will grow at 20%. And that's what you see on the table on the right. It does not matter COVID हो रहा है, malaria हो रहा है, RBI rates cut कर रहा है, drop कर रहा है. It does not matter. The Indian monopolist, the table on the right shows, compounds profits at 20% metronomically. Metronomically. Even this fiscal is not on the chart because it's not done. This fiscal, the top 20 monopolists are going to give you 20% profit compounding. Right? That is the power of this machine. It does not care what disease is happening, what macro is doing, the Indian monopolists will keep slamming back into the business. Capital, factories, capacity, products, and the compounding engine works at 20%. Now look at the Nifty. Nifty, right hand side chart, Indian monopolist profit compounding the best part of 20%. Nifty profit compounding, or BSE 100, not to pick on any index, BSE 100 profit compounding close to negligible. Now, let's make a broader point. I said you can go to the Ministry of Corporate Affairs site, get data on 20,000 companies, right? If you download that, subtract from that the top 20 monopolists ka data, top 20 monopolists ka profits. Indian profit compounding, pure country ka profit compounding, sans the top 20 monopolists is 1%. 1%. Everybody else, 1%, elite, 20%. And that's why obviously the elite's profit share is zipping through, right? It's powering through because they're consistently growing their business at 20%. And for anybody who doubted it, and obviously we have lots of doubters in our country, rightfully so, it's good to be skeptical. The December quarter addresses a lot of their skepticism, because you're seeing powerhouse monopolies pushing through 20-30% profit growth. Now, right, let's go another level deeper and ask ourselves, why is it that these sorts of 20-25 elite monopolists, why can they grow their business at 20%? Why can they earn 45% ROC? Why can't everybody else, right? Now, if you go into the qualitative aspect of it, broadly speaking, there are two ways to build powerhouse monopolies in India, right? The traditional style, let's call it the traditional style, was to go and capture a regulator, right? These are obviously powerful families, wealthy, well-connected. For them, capturing the sector regulator was honestly not very difficult, right? And that's been done. I also have to confess, several companies in our portfolios have captured the relevant regulator, right? It's the way of the world. There's no wrong or right. They have done it. They make money from it. Kudos to them. The second way to do it is to use technology. The second way to build a monopoly is to use technology. An Indian monopolists have two types of sort of technological tacks. One tack around technology is around process chemistry, right? So both in our consistent compounder portfolio and our little champ portfolio, there are several process chemistry monopolists. To cite an obvious one, Divis Lab. Divis Lab makes 70% of the world's naproxen, the world's biggest painkiller. And for all intents and purposes, in naproxen API, it is a monopolist. But the monopoly is predicated on the use of process chemistry techniques that only Murli Divi and his family know, or his chemists know. The rest of the world doesn't know that, right? And we'll come back to this. A big part of India's next generation monopolists are coming through with process chemistry monopolies, right? One of the most exciting areas, I think, for all of us to work on. The next generation Divis labs, basically, right? We'll come back to this right at the end. The other way to go about it is to build a dominance, barriers to entry around using technology, data science, and business process re-engineering to take your manufacturing efficiency and your working capital efficiency to a place where your competitors cannot go, right? And in our portfolio, as you might have heard me discuss before, companies like Asian Paints, like Pidilite, like HDFC Bank, like HDFC Life, like Bajaj Finance, like Dr. Lal Path Labs, they are basically big data, business process engineering, and manufacturing efficiency or process efficiency driven monopolists. We'll discuss one. We'll discuss Relaxo in more detail in a bit, right? Broadly, two ways to build a monopoly: Purana style, old style, regulation; new style, technology. New style, two families: process chemistry monopolies, plenty coming through, and business process and data science monopolies, right? Several already in play, and we'll discuss one more. So much of what I've spoken about so far is the thinking my colleagues had done in the years running up to 2018, early 2019, right? In 2019, the analysts at Marcellus did another data crunch, and we spotted the rising giant story, the next generation story. What we spotted initially was the chart on the top right. What we spotted was that the BSE 500 churns at an extraordinary rate. Every year, 50 companies fly into the BSE 500, which means over a 10-year period, over a 10-year period, the entire index almost churns through, right? And that was extraordinary. The BSE 500, as many of you know, begins at around $500 million, right? $500 million is the sabse chota stock. So every year, 50 companies break through this $500 million threshold. As we looked at the lists of these 50 for the last 10 years, we realized several of these entrants are mini monopolies. Companies who are just as dominant in their niche industry as, say, Nestle is in baby milk, or Asian Paints is in paint, or Pidilite is in adhesives, right? All Marcellus stocks, all of these three. But we realized that there's another generation of Nestle's, Asian Paints, Pidilites waiting in the world below the BSE 500, right? So we got really interested, we got stuck into these, and we realized, and that's when the realization hit us with full force. What these guys are doing, the what we call a Little Champs portfolio, the Marcellus Little Champs portfolio monopolists, sub BSE 500 companies, they are basically emulating the Asian Paints, Pidilites of the world. Some of them have read The Unusual Billionaires, my 2016 book, and they're quite consciously hiring management consultants and saying, "Jaise Asian Paints ne kiya, copy paste that into my business," right? And 2016 we published that book, Unusual Billionaires. By 2020, you could see the pickup in operating margins, asset turnovers, free cash flow, operating margin, asset turnovers, working capital cycle, and free cash flow. These companies are basically building themselves quite consciously into monopolists in their sectors, right? Now, the bottom right chart, what we're trying to show you there is, when you go from being small cap, which is the smallest dot on the bottom right chart, so where it says sell range, it should have said small cap. When you go from the smallest dot in the bottom right chart, when you to the largest dot, which is large cap, basically the stock market re-rates you, right? When you are $300 million market cap, barring geeks like us, nobody else knows about you. Your PE multiple is 13, 14, and a lot of people say महंगा hai, right? That sort of usual PE mentality. And then when you go from 300 million to 3 billion, 3 billion is where, say, Relaxo is today, the whole world discovers you. Foreign investors, private equity investors come and buy you, right? And you re-rate. So that journey from smallest dot, where your price to book is 1.2, to largest dot, the large cap dot, where your price to book goes to 3.5, you re-rate 3x, your P or PB re-rates 3x. Even if your earnings growth just sustains at 20%, which is typically the conservative number I like to use, even if you're seeing earnings growth just sustains at 20%, that tripling in 10 years in the price multiple gives you and me enormous returns. If you just get 20% compounded, that's 8x in 10 years, because that's the compounding power of earnings. But if the price to book re-rates 3x in a decade, right, you're adding on 8 threes and you're getting to 24, 25 times, right? And that potential is what led us to launch Little Champs. When we did the marketing, we deliberately tried not to talk too much about the re-rating, because we can't guarantee the re-rating, right? All we talked about was the underlying compounding. The re-rating has come through in the last couple of years. My reckoning is, if that economic cycle I was speaking to you about comes through, the re-rating should sustain. Now, we'll go deeper into the rest of the session on what sort of companies, what sort of sectors will you find more of these Little Champs, right? So in our portfolio, we have stocks like, as many of you would have heard before, we have, say, from the chemistry construct, we have Alkyl, Amines, and from the chemistry, the process chemistry monopolies, we have GMM Faudler, which provides the ceramic vessels for this. Again, staying with process chemistry, we have a company called Ultramarine Pigments, right? We'll discuss more of these and why we believe there are three big sectors: financials, chemicals, and agro, which will produce giant monopolies in the next 10 years. But before we get there, some reading up. Let me give you 3 books which will give you the deepest concentrated insights on how monopolies are built, right? If you guys don't like reading and you just want to read one book in your life, read 0 to 1 by Peter Thiel. It should be the monopolist kind of Bible, right? You should wake up in the morning and read a few pages of 0 to 1. Again, if you don't like reading, he's made it easy for you. Go to YouTube and watch the 1 hour video called Competition is for Losers. Right? 1 hour Peter Thiel video, Competition is for Losers. Honestly, the book and the video complement each other beautifully. If you read the two, it's like a master class in business building from one of the smartest thinkers. What Thiel is saying, he's saying 99% of businesses fail to build monopolies. 99% of businesses fail to generate meaningful profits. In practical terms, 99% of businesses are operating as charities. They're not getting a return on capital commensurate to cost of capital, so charity hai. His focus is on that 1%, which is monopoly builders. And he gives you in the book his prototype for building monopolies. Right? You could disagree, you could agree, but it's an incredibly clearly written book. Peter Thiel and Elon Musk, as many of you know, created PayPal. And therefore, he uses Tesla as a case study. He uses Amazon as a case study. And then he gives you what I call contra case studies. Crazy sectors, crazy entrepreneurs who build it the wrong way and therefore don't build monopolies. They just burn through a lot of cash, right? So video YouTube mein watch karo, easy to watch, super. Means that once you start that YouTube video Competition with Losers, I challenge you to stop it. It's so interesting. It'll just suck you through the 1 hour, right? So Thiel, as the sort of modern day thinker, what's fascinating about reading Thiel's book, I read it around 5 years ago. I have to confess, I don't think we would have had the courage to set up Marcellus had we not read Thiel. But what's fascinating about Thiel's book is many of the Indian promoters who are in their 60s, the unusual billionaires who are in their 60s, they think just like Thiel, just that they were smart enough to figure out Thiel 30 years ago, right? The Indian unusual billionaires figured out Thiel 30 years ago. People like me who have no business background needed to read the book and figure out, boss, isme dam hai. Another very interesting book is Myth of Capitalism. It was published last year. This guy, Jonathan Tepper, has taken up the cudgels against the technology monopolists. And he gives you in great detail how the tech monopolists, companies all of us are familiar with, how they proactively destroy competition, right? But what's very interesting about Jonathan Tepper's book is he also describes the monopolization of US agriculture, right? We'll come to agriculture in a bit. I think it's one of the mega sectors that will get monopolized in the next decade. And therefore, to understand how American agriculture got monopolized, it's worth reading Myth of Capitalism. The most rewarding but the hardest of the three books is Robert Gordon, The Rise and Fall of American Growth. It's a big book. I would suggest if you were pressed for time, just read the first 150 pages. It is enormously rewarding because it allows you to contextualize this current time, period, minute, moment in India. What this guy takes us through is America between 1880 and 1930. Because that's the 50 years in which America went from being a village economy to an industrial superpower. Basically, America got formalized, networked in that 50 years. 1880s mein, the railroad came to America. 1890s mein, the telegraph came to America. 1910 mein, the Model T Ford came to America, the road network got built. So from a village economy in 1879, they became an industrial power. In 1879, they did not have any well-known FMCG companies. All the American FMCG companies you and I know of, they were created in that 50-year period, right? So Heinz and Kellogg's and Pillsbury and Wrigley's and so on. In 1879, America did not have a single supermarket. In 1930, they had 500,000 supermarkets. And networking a country immediately spurs formalization. Formalization kills the chota company. Formalization creates leviathans, creates giants. And what all of us are living through in India is the networking, the formalization of our country. Our road networks have tripled in the last 20 years. Broadband connections are up 400x in the last 15 years. Domestic passenger travel doubles every 5 to 6 years. That means it pentuples in a decade. GST has obviously integrated the country. As you network India, as you integrate India, as you formalize India, we will naturally create giant monopolies. What that book allows you to do is understand this in like a movie style, right? First 150 pages, I wish somebody would turn it into a movie. Hopefully one of you in the audience will. Let's do a case study, right? So, one second. So this chappal, right? I am very proud of it. It's my 103 rupees ka Relaxo chappal. This chappal is an instrument of enormous wealth creation. This chappal is a monopoly. This chappal is a monopoly. Nobody can compete with this chappal, right? Now, I'm not making it up. You can go to Amazon.in and check. This chappal retails some days for 90 rupees on Amazon, some days for 103, some days 110. There must be an algo behind it, algo that Amazon must have built. By far on Amazon, that Relaxo ka chappal is the cheapest chappal. Nobody comes close. The closest a company comes is a company called Paragon. Their first chappal starts at 139, right? So imagine chappal, nothing more. One guy is selling at 88 rupees, next fellow at 139, bunch of other crazies selling it at 400, 500, some foreigners selling it at 1500, right? Now, there's a market for everything. People like me who don't like spending money buy the 103, but I love these sorts of things because it gives you straightforward insights into giant monopolies, right? So let's get underneath the bonnet and understand how this monopoly was built. There's no government setting wetting. This is a straightforward business process tech-driven monopoly build, right? Let's start with the numbers. So if you look at the table on the bottom right, Relaxo's profit growth in the last 5 years, including COVID impacted FY20, has been 18%, right? This last 2 quarters has been spectacular, but 5-year average, 10-year average, typically they gun out 20% profit compounding, right? If you see the revenue growth, 5-year revenue growth, it doesn't look too impressive until I tell you that larger companies like Bata have grown at 1/3 the rate of Relaxo, right? And when you put, say, Bata, which is I think the most credible of the larger footwear companies, you put Bata and Relaxo next to each other, a fascinating picture jumps out. We just discussed Relaxo's 103 rupees chappal. You'll see Relaxo's products typically retail for 100 to 400 rupees, right? Typical product. They have some expensive product, but 100 to 400 pretty much is their world. As many of you know, Bata obviously sells for 5, 6, 7x that sticker price, right? Yet, profit margins are identical. Return on capital is identical, right? So 2 companies, one company, Relaxo, is selling at 1/6 the price or in terms of sticker price, but same profit margins, same return on capital, and the company selling the cheaper product, growing the top line thrice as fast, right? How does this happen? How can I build a business like this, right? So here I'll take you a little bit into Relaxo's past, because until you understand the backstory of how a monopoly is built, then you're a perpetual victim of this PE multiple psychosis, right? You've got to go into the backstory to break away from the PE multiple psychosis. So the Dua family hails from Delhi, Punjabi family from Punjabi Bagh in Delhi, which is a suburb of Delhi, which say Shah Rukh Khan also hails from that, from what I understand. So the Dua family owns 74% of Relaxo, right? In the 1980s, till the 1980s, they were a plastic wholesaler in the NCR region, the Delhi region. By that I mean, they used to buy plastic in the wholesale market and sell it to the footwear industry, right? Late 80s, early 90s, on the back of liberalization, they entered the chappal market. They started making chappals using the same plastic that they were selling to others. But I don't think, and I have to be honest, I don't think even I had heard of Relaxo in the 90s or even the early noughties. The first milestone is the recruitment of Accenture. So 2004, the Dua family bought Accenture in for a management consultancy contract, which went on to last 12, 13 years, right? And Accenture did the first 2 layers of comparative advantage building, right? The first thing Accenture did was spotted that the footwear industry does not use SAP. They do not do supply chain management using SAP. So by dint of installing SAP, gradually Relaxo's receivable days, revenue collection days, came down from 90 to what is around 30 days today. Revenue collection cycle of 30 days. So if you look at the other footwear companies, they still take 90 days to collect revenues. Relaxo collects at 1/3 the time, even though they're selling at 1/7 the price to people like me, right? So they crush the revenue collection cycle from 90 to 30. Now, any company that collects money quicker will generate free cash flows, right? Free cash flow बढ़ जाएगा, right? So Accenture and the Dua family then made a very counterintuitive call, right? And this is the sort of most magical aspect of monopoly building. There'll always be a counterintuitive call. And the counterintuitive call here was to take that free cash flow and build factory after factory after factory. Because everybody outsources footwear, right? Those of you who read about Nike's history, Nike outsources famously. Bata outsources, I think Metro Shoes also outsources. Everybody world over outsources footwear. These guys said, we're gonna insource, right? Counterintuitive call. Why? Two reasons. They've spotted two things that the rest of the people hadn't spotted. The first thing they spotted was that the Dua family, because they had historical antecedents, skill set in the plastic market, they could get plastic cheaper. They had skill sets at getting cheap plastic. If they outsourced, they were not turning their skill set into a competitive advantage. So they said, nahi karenge, we're going to make it in-house. We're going to take our historical skill set and getting cheap raw material and turn it into a competitive advantage. The second thing they spotted was nobody in India, nobody has built scale in the manufacture of footwear. As a result, you could argue nobody in India has built scale in most things, but in their case, they spotted it in footwear. As a result, they realized if they build scale in the manufacture of footwear, they will have a very powerful competitive advantage. Right? And Ramesh Dua Saab, the patriarch who runs Relaxo, went on to execute brilliantly. In the last 16 years, they've built 9 factories in a place called Bahadurgarh, just outside Delhi. Basically, every other year they build a factory. You can see that, right? See the ROC row. ROC goes 30, 30, 26. That's the factory built. Then it comes back to 30 as the factory gets sweated. Again, 26 as the factory gets built. Typically, it comes up 20 mein nahi aaya because of COVID, right? This year, the ROCs dipped back to 30. So every other year, they basically put up a plant in Bahadurgarh, just outside Delhi. And the result is as powerful as it is simple. Relaxo's production capacity today is 8 times larger than anybody else in the country today. Now, the result of that is startling. As I said, this is the cheapest chappal on Amazon. This 103 rupees ka mera chappal is the cheapest chappal on Amazon, right? Yet, on this product, their gross profit margin is 60%, right? Same as Bata. Their operating margin is 16 or 17%, same as Bata. The return on capital employed is 30%. 103 rupees ka chappal. 8 times larger production capacity. So that was the first layer of build. 2015, 2016, 2 other consultants came into the picture, BCG and Deloitte. And then began the next stage of comparative advantage building. And if you read Unusual Billionaires, the staging is very typical of the Indian monopolist. Step by step by step, you keep at it. First thing these consultants said is, they said, sir, you've done such a tremendous job in chappal. You have driven everybody else out of the market. So Bata no longer makes Hawaii chappals, by the way. Why don't you replicate this formula in sandals? Why don't you replicate this in sandals? So some of you might remember 7-8 years back, these imported sandals called Crocs came to India, right? Plastic, colored, very colorful things, right? Very popular, but very expensive. Used to make my eyes water whenever we bought a Crocs, right? So Relaxo did a desi version of Crocs. It's called Flight, F-L-I-T-E. You can buy it online, right? Plastic covered, how expensive can it be, right? If you look at the Crocs price and the Relaxo price, you say, was paisa banega India mein, right? Just go online and check it. You just say, you see the product and you go mad, right? So obviously they cleaned up. They cleaned up the sandal market, entry level. They're not trying to do anything fancy. Entry level products starting at 180 rupees, unka Flight brand. And I think that the most expensive Flight will be 700, 800 rupees. And that gave them the confidence to do sports shoes. So they hired Akshay Kumar as a brand ambassador and did Sparks, S-P-A-R-X, entry-level sports shoes. And that's also done pretty well. So basically, 2015, 16, 17, they fleshed out the offering. Not just chappals, sandals and shoes as well. All entry-level, super, super inexpensive. Then their consultants pointed out that, look, you are using wholesalers. You're using wholesalers to sell the product. You can't build comparative advantage by using wholesalers, right? So for example, 5 years ago, for the whole of Rajasthan, they would have one wholesaler. They would give the fellow the consignment and say, as long as you pay me, what you do with it is your headache, right? And you can't build comparative advantage like that. So 2016, 17, 18, they appointed a distributor for Jodhpur, one for Jaisalmer, one guy for Bikaner, one guy for Jaipur, right? And then they pushed these distributors to go and appoint dealers, shops on the high street who will carry their products. The result today is, if you see, Relaxo has around 30,000 dealer touch points, twice as many as Bata, thrice as many as anybody else, right? So now let's do a recap. What are the 4 things they have built in the last 15 years that nobody else has? The widest range of products at the entry level, the widest range of dealerships by far, the lowest cost structure, the tightest working capital cycle. And why is this a monopoly? They sell 18 crore pairs per annum. Now let's just step back and think about India. India has 130 crore people, 30 crore like all of us. We buy Nike, we buy Bata, we buy Adidas, we go to malls, we're affluent people. India has 100 crore people who live on less than 1 lakh rupees per annum. India has 1 billion people who live on less than 1 lakh rupees per annum. Those guys won't be able to afford Nike, Adidas, malls, Bata. The annual income is 1 lakh ya usse kam. Those guys, for them, the only organized sector brand that is relevant is Relaxo. And that's why that 80, 90, my 103 rupees ka chappal is an enormous instrument of wealth creation. Because 18 crore pairs is what Relaxo is selling. That means 80% of the market is in the hands of the informal sector. Tax evading manufacturers in wherever, Ulhasnagar or Tirupur or Kanpur or wherever. And as everybody knows, and now everybody can see, COVID, GST, demon is completely compressing this informal sector. And as these guys die, the 80% die, the entire market folds into the hands of the Dua family, right? Obviously, unless anybody here has any other contrary viewpoints, this is going to be a straight 10-year ride, because this price point will keep getting more competitive, right? As they build more and more scale, the price point will get more and more. This is a classic monopoly construct, right? You keep cutting your prices 1 or 2%, costs are rising at 6%, everybody else falls behind by 5-6% a year. 10 saal mein, you're in a class of 1, you are the king of the footwear sector, right? So you ask any other footwear manufacturer, they will tell you, if I could start life again, I would not be selling to this audience, too competitive. We would be selling to that 100 crore Indian janta who earns 1 lakh or less. Now, how much money can they make? Today, I think market cap is 2.8 billion, right? So assume just 20% compounding, nothing more, right? Nothing spectacular. That means a decade hence, there'll be 8x today's size, there'll be 20, 21, 22 billion. That means that a decade hence, Relaxo is likely to be what Nestle India is today, right? And there's nothing fancy here, straightforward stuff. Chappal monopoly built through epic efficiency that nobody else has been able to deliver. And this is the template that other aspiring monopolists are replicating and giving you and me great products and services without any competition. And this journey continues, right? So let's look for 3 other sectors where we think the monopolization construct is all set for epic takeoff. First one, the biggest sector in our country, the largest sector of the economy, by far the largest sector in the stock market, financial services. Epic monopolization hoga yahan pe, right? Why is that? Let's take banking as an example of why we will monopolize. Banking has 65% market share in banking belongs to anybody? PSUs, right? Everybody knows that, right? Now, last 20 years mein, no PSU bank has generated a return on equity above their cost of equity. So how have they survived? All of you here, all of us have paid income taxes to Bharat Sarkar. Bharat Sarkar has taken our money, put it in the balance sheets of the PSU banks. What Bharat Sarkar is saying very politely to these PSUs is, khatam hai boss, story khatam hai. We have no more money to give you. They do a token recap. If you saw the budget this time, token recap, 20,000 crores, which doesn't, it's probably the canteen budget for some of these people, right? So they do a token recap, but paisa aana band ho gaya inka. Now, if you take away capital support from the government for 65% of the banking sector, what will happen? That market share will migrate. Where will it go to? Will it go to some unknown obscure bank? Or will it go to the giant banks which are well run, clean, highly efficient? My uncontroversial submission would be the latter. So a Kings of Capital portfolio is loaded up with these. Right? And we can make a lot of money, we think, in the next 10, 15 years. So can you, by loading up on clean, well-run private sector banks. They just have to carry on doing what they're doing. As the PSUs shrink, they will hand over, the PSUs will hand over the banking sector, right? There's another aspect to this, which is what all of us are doing this morning, right? What are we doing? We're trying to financialize our wealth. Why are we doing it? Because we are rational people. We have realized that by buying more flats and buying more gold, we can't compound our wealth at a serious rate. Now, just some numbers around this are very useful. The RBI has repeatedly pointed out that 95% of India's household wealth is in physical assets. The RBI has further said that this skew, 95 physical, 5% financial, is without precedent anywhere in the world. The RBI has further opined that this is unsustainable. You cannot run, forget the country, nobody can finance their retirement by having 95% in physical. A retirement with modern medical care will last 25 years. You're not going to finance it by your rental income from your flat in Sarjapur or Panvel or Noida, right? If the rental income would be enough to buy you a sort of meal at a UDP restaurant, that'll be a good outcome. Forget funding your retirement, right? So we are at 5%, our total household wealth, only 5% is in financial assets. Roughly India's household wealth is 10 trillion. That means our total household financial assets are half of that of Jeff Bezos. India ka total household financial assets are half of that of Jeff Bezos' wealth or Elon Musk's wealth. You can take your pick, right? That is obviously not logical. 70 years after independence, a country like ours, the world's 5th largest economy, can't have $500-600 billion in financial assets. We will save more. Now, how much more will we save? Let's do some very conservative assumptions. Let's assume this 5% becomes 6% next year, 7% the year after, just 1% a year movement. 1% of 10 trillion is 100 billion. So if each year we add $100 billion of financial savings, in a decade, our financial savings pot as a nation will be 1.5 trillion to half a trillion today. Basically, the market itself for financial savings will treble, right? And in that trebling market, companies who gain a little bit of market share and show some operating efficiency will comfortably compound earnings at 20%. So therefore, the other way to play the second facet, not the PSU bank wala, the financialization savings, is buy the best life insurers, the best general insurers, the best wealth managers, and the best asset managers that you can find. And we have done that in the Kings of Capital portfolio. You can do it yourself. Epic story. And unless something incredibly crazy happens, this is driven just by the need for people to have a liquid retirement pot that they'll finance them in the last 25 years of their life. Let's come to agriculture now, right? Everybody knows about the farm reforms. Read Jonathan Tepper's The Myth of Capitalism to understand how agriculture was monopolized in America. Basically, what he describes is American agriculture works in a 3-tier monopoly system. First is the procurement of food grains is monopolized by 2 or 3 giant corporates, right? For some of you who sort of know the world, I learned it from the book, firms like Cargill, Bunge, right? 2 or 3 giant companies procure at the farm gate. Similarly, Cargill, Bunge do it for food grains. There's some other company called Tyson which does it for poultry, right? So the procurement at the farm gate is monopolized. Then these guys sell it to the processors, the food processors. The food processing industry is also monopolized, right? American giants, Kraft Heinz, Unilever monopolize the processing. Those guys sell it to the retailers. The retailing is also monopolized, Walmart, Amazon, etc., right? We're going to go the same way. It's very, very difficult to see otherwise. So through December, I haven't been on a flight for 9 months, but through December, we did a lot of travel around the Maharashtra countryside to see the first stages of the monopolies forming in agriculture. So the mandi ecosystem looks likely to monopolize first. There's enormous network effects in monopolizing the mandi network in India. And then from mandi monopolization, you go to procurement monopolization. processing monopolization, and then retailing monopolization. 10-year journey. I've lived in this neighborhood for 12 years, and I can see firsthand how the Kirana stores are shutting down and how the retail monopolization is paying out. In everybody's building, I'm sure you see the Amazon packs, the GeoMart packs coming to your building. So retail monopolization is underway. The FMCG monopolies we discussed in the preceding slide, just the procurement at the farm gate, I think enormous potential there for monopoly building. And the last piece, specialty chemicals, right? This sector seems to be standing where, Indian IT services stood in the early 90s and Indian pharma stood at the turn of the century, right? There are a couple of things which are at least evident to us. How much money we can make, only time will tell. The first piece is the West and China are being very clear. They don't want to manufacture more chemicals. The world needs industrial chemicals, but the West and China are saying that we don't want this. It's the environmental cost is too high, right? Plus, there seems to be, at least when I speak to people in the West, they're saying there are very credible studies showing that if you build up a spec chem industry, cancer incidence goes up. So it's very clear that spec chem will migrate somewhere else, and it looks as if our country is the obvious place for spec chem to migrate. There is an environmental cost, but here we are focusing on which companies can make a lot of money out of it. So that's one driver. Second driver is, in common with pharma and in common with IT, our country has abundant labor in this regard. Process chemists are very good at their job, and there are in fact consultancies and experts who will give you off the shelf 50 molecules, he'll say 50 molecules waiting to be monopolized. So our reckoning is, especially say in the belt from Ahmedabad through to Bombay, Pune, a lot of chemical monopolies are in the make here. Similarly, the area around Hyderabad, a lot of chemical monopolies on the make here. And we've got some of them in little champs, people like Alkyl, Amines, people like Ultramarine, but this looks like the beginning of a massive story, right? And just to end, the common theme across all of these is small cap companies have figured out that if you use Relaxo style techniques, Asian Paint style techniques, Bajaj Finance style techniques, you can build efficient, highly profitable businesses over the next 10, 20 years. And for more on these are our 4 books on the subject. We hope you'll read the books, and this being India, obviously, you can download them for free on the pirated platforms in our country. Thank you very much for listening. Thanks a lot. Thanks.
Great. So we have a question from Dattatreya Joshi from Bangalore. The Marcellus PMS performance may lag behind the cyclical trends. With this background, is it not a good idea to start a separate PMS by you only to invest in these cyclical stocks, or in the stocks or sector which has underperformed for long, but you can see value investing for short term?
So I think it's a fair question, and each investor has their strengths. Each investor has their strengths. As I said, our strength is very much this approach. You look for companies who are doing a good job. First, as you might have heard us say before, first layer is you check out the forensic accounting, make sure that the books are clean. Second layer is you look for mass market products. We discussed chappals today. We have discussed paints before. We have discussed baby milk before. And the third layer is you look for dominant monopolists, right? What we are not trying to do is time the cycle. And it's very tempting to do so. It's very tempting to say, let's buy PSUs. The challenge with that proposition is you don't know when the rug will be pulled under you. I don't know when the rug will be pulled underneath me, right? So there have been many waves of PSU enthusiasm in India before. It has sunk the careers of some of the most illustrious fund managers in our country, this whole PSU enthusiasm. And why, if you get it right, you look like a rock star. If you get it wrong, it's not that you look stupid. I have no problem with looking stupid. It's just that you cost your investors money, right? Our view is, our job when we come to work is we're going to give you a return on capital consistently above your cost of capital, right? Assuming your cost of capital is 15%, we're going to gun out 20%. And we can't sort of say, we bought PSUs, not our fault, they didn't get privatized. Because then you will say, Saurabh, I could have done that. I could have watched TV and played PSUs. And you're welcome to do so. But we don't have any skill set to do that, specifically because we don't know when the rug will be pulled underneath our feet. Secondly, even if we had the skill set to do that, we don't have any visibility on can we get you 20% compounding from companies. Remember, we're trying to get you 20% compounding from companies whose ROC does not even hit 11, 12, 13%. And logically, therefore, you'll look at me and say, this is mad. I mean, why are you doing this? If the company does not generate an ROC of 12, 13, 14% at least, why are you even punting my money on it? So there are others who can do it. I suspect they have a skill set that we don't have. Our skill set is around this aspect. And as I said, at a stage of development like ours, a per capita income supposedly is $2,000. That's the official number, right? But when you realize that 1 billion Indians live on 1 lakh a year or less, you realize how much potential the nation has. With that sort of epic potential, to faff around trying to do, cheap PE stocks, what hasn't worked, it's losing the bigger picture. The bigger picture is this country has 10, 20 years of remarkable growth ahead of it. If it hasn't, then none of us will make money, by the way. You can all forget it and go home, right? So, by buying cheap PE stocks, if growth doesn't come, you're not going to make money, right? So the bigger picture is this country has delivered in the last 20, 30 years. I showed you on this chart. It's reasonably easy to read India's economy. Over the next 10, 20 years, especially the billion poorest will rise up. Their standard of living will go up, and all of us can make money from investing in the rise of 1 billion people, so to speak. To then say, let's now distract ourselves by looking for a PSU on a cheap P, I think is a shame. But I'm not stopping anybody from doing it. Feel free. We don't want to distract ourselves from this goal of choosing the next generation of great monopolists.
So that was particular to the PMS. So I hope you've got the answer on that. Great. I'm going to pick a question from Bharat Nagraj, who's watching online. Why do you think Indian companies in the future will not face more competitions, which can, to an extent, reduce their ROC, etc.?
Right. So it's the same reason why Indian companies today. I gave you the Relaxo example. So let's look at Relaxo, right? Because it's as basic a product you can imagine, right? I don't think there's any great science in the chappal. Relaxo's profits are 230, 240, 250 crores. That sort of area, 250, 250 crores. For a world-class Western company, 250 crores profit is sort of like small change for them. They're not gonna come in, right? It simply doesn't bother them. So who's gonna attack Relaxo? Relaxo is most likely to get attacked from a 20-something, 30-something entrepreneurial Indian who's hired, maybe not Accenture, but say a local IT consultant to improve his working capital efficiency, to improve his process efficiency, right? And say someone like Campus. So someone like Campus has hired I think a really bright IT consultant in Delhi to basically do a mini Relaxo, right? Now, if I am Campus and I have read 0 to 1, or I am a instinctive Indian promoter who understands 0 to 1 without reading the book, I'm going to choose a niche. I'm not going to go head to head. No smart monopolist will go head to head in the main product of the rival. So what did Elon Musk do in Tesla? He did not launch the sedan first. He launched that $110,000 wala car, right? I'm going to choose a niche that nobody else is catering to. I'm going to capture that niche. I'm going to build my first monopoly in the niche. That's my process, my team, my go-to-market method perfected. Then I'm going to ramp outwards in concentric circles, right? So what our job is to do is keep an eye out for people like this in the footwear market. There are promising companies. I think VKC in South India, it's unlisted, very promising. They've done a very good job in South India. Campus is doing a pretty good job in the shoe market. But in the core chappal market, where this 100 rupee product has an unassailable lead, that is our focus. Our reckoning is that market, nobody else is going to attack. There are other elements of footwear, right? VKC, South India, Campus, a specific part of the footwear market that others will monopolize. And we reckon we can make money there as well. But for full-on competitive intensity to drag down Relaxo's margins, I think it's a 7-8 year out story. Let's assume that they do face that competition. Right? Then you get to the second level of monopoly skill in India. What is the second level of monopoly skill in India? The Indian monopolist knows when to jump into the adjacency. right? We have seen two great examples of this. First is Pidilite. 1970 to 2000 was the Fevicol wala build, right? In 2000, 2001, they acquired from M&M, the waterproofing brands. Last 20 years has been the waterproofing build out, right? 90% market share, 90% profit share, and now in adhesives and waterproofing. If you read the annual reports, what are they doing for the last couple of years? They're buying specialist companies who specialize in, say, flooring for hospitals, for sports stadiums, EPC companies who install flooring. This, they won't obviously reveal to us their core next monopoly. Our reckoning is the next monopoly is around flooring, right? Very similarly, Page Industries and Sundar Ganumal Saab ka build out, right? First, grab the women's wear, women's undergarment market. He's a fortress franchise. Women's undergarment, you cannot compete with Page, no chance, right? Then they went into men's undergarment, where they faced more competition than women's undergarment. Then they figured out a couple of years back कि men's में competition is greater. Lux hai, Rupa hai, Van Heusen hai. And very cleverly, before anybody else could spot it, they did leisure wear, lounge wear, and kids, right? So Ganumal Saab is doing this, the adjacency build out, right? Now, why is the adjacency build out a great strategy? Because if you dominate the first area and you're generating heavy free cash flow, in your first core area, you're then using these profits to capture the adjacency, right? And before anybody else can come into the adjacency, you become the king there. Then others attack the adjacency, you go to the third area. So Pidilite is Fevicol, waterproofing, and now third, Ganumal Saab also, you could argue women's undergarments, men's undergarments, and now loungewear, third build out, right? And that's the skill of the monopolist. That's where you need him to be clean. You need him to be hardworking. You need him to be focused. The business has to matter to him. Winning every year, not just having a ton of money, winning every year has to matter to the monopolist. And that's why studying these monopolists, their psyche, their behavior, their priorities